We all work hard for our money. But did you know money sitting in a regular bank account is actually losing value? That's because of something called inflation. Inflation means prices of things go up over time. To beat inflation, you need your money to grow faster than prices rise. This is where investing comes in. Investing is like planting a seed. You put your money into something with the hope it will grow into something bigger. There are many ways to invest. Two popular options are stocks and mutual funds. Understanding these options is key to making your money work for you. Let's break down these options so you can make smart choices for your financial future. Remember, knowledge is power when it comes to your money. Imagine owning a tiny piece of a big company like Apple or Amazon. It's like having a small slice of a giant pie where each slice represents a share of the company. That's what a stock is. A stock represents a fraction of ownership in a company, and owning stocks means you have a claim on part of the company's assets and earnings. When you buy a stock, you're buying a small share of ownership in that company. This means you become a shareholder, and your investment can grow as the company grows. Companies sell stocks to raise money. This capital can be used for various purposes, such as expanding operations, developing new products, or paying off debt. If the company does well, the value of your stock goes up. This increase in value can be due to higher profits, successful new products, or overall market growth. You can then sell your stock for a profit. This is known as capital gains, and it's one of the primary ways investors make money in the stock market. But if the company does poorly, your stock value could go down and you could lose money. Factors like poor management, economic downturns, or increased competition can negatively impact stock prices. Stocks can be exciting because they offer a chance to make significant profits. The thrill of seeing your investments grow can be very rewarding. However, they can also be risky, especially for beginners. The stock market can be volatile, and prices can fluctuate widely in short periods. It's important to thoroughly research any company before investing in their stock. Look at the company's financial health, market position, and future growth prospects. Remember, investing in stocks is a long-term game. The stock market has historically trended upwards over the long run, despite short-term volatility. Don't expect to get rich quickly. Building wealth through stocks requires patience, discipline, and a well-thought-out investment strategy. But with patience and smart choices, stocks can be a powerful tool for building wealth over time. Diversifying your portfolio and staying informed about market trends can help you make better investment decisions. Consider seeking advice from financial advisors or educating yourself through books and courses on stock market strategies. Knowledge is a key asset in navigating the complexities of stock investing. Joining investment groups or attending seminars can also provide valuable insights and help you stay updated on the latest market trends and opportunities. Setting clear financial goals and having a well-defined investment strategy can guide your decisions and keep you focused on your long-term objectives. Ultimately, the journey of investing in stocks can be both challenging and rewarding. With the right approach, you can achieve your financial goals and enjoy the benefits of your investments. Investing in individual stocks can be risky. The stock market is volatile and prices can fluctuate wildly based on a variety of factors, from company performance to global economic conditions. What if you're not sure which companies to choose? With so many options available, it can be overwhelming to decide where to put your money. That's where mutual funds come in. They simplify the process by pooling money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. Imagine a big basket filled with stocks from many different companies. That's a mutual fund. Instead of putting all your eggs in one basket, you spread them out across many. When you invest in a mutual fund, you're investing in all the stocks inside that basket. This is called diversification. Diversification is a key strategy in reducing risk. Diversification helps lower your risk because if one company in the fund does poorly, others might do well and help balance things out. This balance can provide more stable returns over time. Mutual funds are managed by professionals. These fund managers have the expertise and resources to analyze market trends and make informed investment decisions. These professionals choose which stocks to buy and sell within the fund. They continuously monitor the market and adjust the fund's holdings to optimize performance. This can be a huge advantage if you're new to investing or don't have the time to research individual stocks. It takes the guesswork out of investing and allows you to benefit from the expertise of seasoned professionals. mutual funds offer a simpler and often less risky way to invest in the stock market. They provide access to a diversified portfolio without the need for extensive research or active management on your part. They are a great option for investors of all levels of experience. Whether you're just starting out or looking to diversify an existing portfolio, mutual funds can be a valuable tool in achieving your financial goals. Additionally, mutual funds come in various types, such as equity funds, bond funds, and balanced funds, each catering to different investment objectives and risk tolerances. Equity funds invest primarily in stocks and are suitable for those seeking growth. Bond funds invest in bonds and are ideal for those looking for income and stability. Balanced funds offer a mix of both, providing a middle ground. It's important to review the performance and fees of mutual funds before investing. Look for funds with a strong track record and reasonable fees to maximize your returns. In summary, mutual funds offer a convenient and effective way to invest in a diversified portfolio managed by professionals. They can help you achieve your financial goals with less risk and effort. So, whether you're a novice investor or a seasoned pro, consider adding mutual funds to your investment strategy for a balanced and diversified approach to growing your wealth. Let's talk about risk. Every investment carries some risk, but investing in individual stocks is generally considered riskier than investing in mutual funds. Why? Remember, when you buy a stock, you're buying a piece of just one company. If that company has a bad quarter, a product fails, or there's a scandal, the stock price can plummet. You could lose a big chunk of your investment. Of course, the opposite is also true. A single company's success can mean big profits for you. But you need to be prepared for the possibility of losing money as well. Think of stocks as a roller coaster ride. It can be thrilling, but it can also be scary. Section 5. Risk versus reward. Funds are a slow and steady race. With mutual funds, the risk is spread out. Because you own little pieces of many companies, the poor performance of one won't hurt you as much. This diversification makes mutual funds less risky than individual stocks. However, it also means your potential for huge profits is less. Think of mutual funds like a slow and steady train ride. It might not be as exciting as a roller coaster, but it will likely get you where you want to go safely. Section 6. Do your homework or pay someone else. Investing in individual stocks requires more work and knowledge than investing in mutual funds. You need to research companies, understand financial statements, and keep up with market trends. With mutual funds, the fund manager does this work for you. They have teams of analysts researching companies and making investment decisions. However, this convenience comes at a price. Mutual funds charge fees for their management services. These fees can eat into your profits over time. It's important to consider how much time and effort you're willing to put into managing your investments and choose an option that aligns with your comfort level. Section 7. Who should pick what? So, who might benefit more from stocks and who might prefer mutual funds? This is a crucial question for anyone looking to invest their money wisely. It depends on your risk tolerance. Risk tolerance is essentially your ability and willingness to endure the ups and downs of the market. If you're comfortable with risk and the possibility of big gains or losses, individual stocks might be a good fit. Stocks can offer substantial returns, but they can also be quite volatile. If you prefer a more conservative approach, mutual funds are usually a better choice. Mutual funds pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Time horizon is another factor. Your time horizon is the length of time you expect to hold an investment before needing the money. If you're investing for the long term, like retirement, stocks have more time to recover from any dips in the market. Over the long haul, stocks have historically provided higher returns compared to other types of investments. Mutual funds are also suitable for long-term goals, offering diversification and professional management. This means your investment is spread across various assets, reducing the risk of significant losses. And finally, interest and knowledge. Your personal interest in financial markets and your level of knowledge can greatly influence your investment choices. If you enjoy researching companies and following the market, investing in stocks can be exciting. It allows you to be more hands-on and potentially reap higher rewards. If you'd rather leave the investing decisions to the pros, mutual funds are a better option. They offer the convenience of professional management, so you don't have to worry about the day-to-day decisions. Ultimately, the choice between stocks and mutual funds depends on your individual financial goals, risk tolerance, time horizon, and interest in managing your investments. Take the time to assess your situation and consult with a financial advisor if needed. Remember, there's no one-size-fits-all answer. The best investment strategy is one that aligns with your personal circumstances and financial objectives. Whether you choose stocks, mutual funds, or a combination of both, the key is to stay informed and make decisions that support your long-term financial well-being. Section 8. So, what's right for you? The best choice between stocks and mutual funds depends on your individual circumstances and goals. There's no one-size-fits-all answer. Start small and diversify. Whether you choose stocks or mutual funds, it's wise to start with a small investment and gradually increase it over time. Diversifying your portfolio by investing in a variety of assets is also crucial for managing risk. Think long-term. Investing is a marathon, not a sprint. It's essential to have a long-term perspective and not panic if the market experiences short-term fluctuations. Remember, the most important step is to start investing. The sooner you begin, the more time your money has to grow. Take the time to educate yourself about your options and make informed decisions that align with your financial goals.